Welcome to Leading on Risk, a locked-in professional and executive risk video series where we share insights on the issues that matter most to your business. I'm Kaylee Di Salvo, a Senior Vice President in Locked-in's professional and executive risk practice. Directors and Officers Liability Insurance, or D&O insurance, is one of the most important protections available to corporate leaders. In a year marked by shifting trade policies, renewed regulatory enforcement, and heightened scrutiny of corporate governance, protecting both personal assets and the corporate balance sheet has never been more critical. I'm joined by Ashley Jones, Senior Vice President, and Joe Class, Vice President within Locked-in's professional and executive risk practice. And we'll look at what's driving today's D&O claims and how public and private companies can build stronger, more effective D&O programs in this changing market. Let's start with the big picture. Why is D&O insurance so important? And why is it critical that directors and officers pay closer attention to their insurance program in this environment?
So D&O insurance remains a boardroom essential, both from a corporate balance sheet and a personal asset perspective. If you think about retaining the best talent in the industry, they want to know that their personal assets, above all else, are being protected adequately. We also see the plaintiffs' bar being much more aggressive in claims being brought against individuals and the entity, and so corporate officers and directors must pay close attention to the coverage they have.
It's also a shifting landscape when you talk about the regulatory landscape, financial landscape, geopolitical landscapes. And so we want to make sure the directors and officers are paying close attention to how their D&O program can remain resilient while these shifts are occurring. We're also seeing an increase in claims severity. And with that can come problems with limit adequacy on these programs. So it's another area for them to pay attention to.
Let's talk about claims. What kind of D&O claims are we seeing today? And how are regulators and maybe shareholders shifting their focus?
So I think the focus from a claims perspective today is heavily on the economic climate with regards to tariffs, trade policy, as we've all seen that tends to fluctuate oftentimes from month to month. And as corporate leaders are trying to give accurate disclosures on a quarterly basis, it makes it much more challenging for them.
And moving beyond the regulatory landscape, I think it's important also to think about how meeting shareholder expectations is really the crux of a security class action. In the securities class action environment, the Ds and Os are challenged by allegations that they haven't met those expectations. And when you have this evolution, if you will, of tariffs, for example, it becomes a heightened area of exposure for them.
I think the other thing to pay attention to is the parallel derivative suits that come along with securities class actions. So about 47% of the time, a securities class action will have a parallel derivative suit. Oftentimes, corporate governance reforms are required as part of those settlements, but about 25% of the time, there is a monetary component to those derivative settlements.
And when it comes to the monetary component of the security class action itself, while we're seeing that the number of such claims isn't accelerating per se, we are seeing that the settlement amounts are still very elevated.
Now, what about shareholder activism?
I think from an activism perspective, shareholders are focusing broadly on financials. They're certainly paying attention to the new administration's approach to DEI, particularly if you have contracts with the government. And then we're seeing a shift from greenwashing to green hushing. And so that's an interesting dynamic that shareholder activists are paying attention to.
Now, M&A activity, is that still a concern?
It is. We're seeing M&A activity increase. We're also seeing non-competition as well, both of those being drivers for claims. Another area that we're keeping an eye on are IPOs. We have seen that many of the companies that are going through an IPO now are doing so as a more mature private company when they enter into that. What the result is that on the backside of the IPO, there may be less room for them to grow materially, which again could result in claims.
When it comes to private and public companies, can you share a little bit about how they may be feeling these pressures differently when it comes to D&O claims?
Yeah, so public companies, I think, are feeling pressure. As Ashley mentioned, companies are coming into the public markets more mature these days. They've been able to raise capital privately for longer. And so now we're in an all-time market high, and I believe that executives are under immense pressure to keep outperforming quarter over quarter to meet shareholder expectations.
I would say on the private company side, we're seeing investor disputes absolutely drive claims. As well, despite the fact that they are private companies, that does not mean that they're immune to regulatory investigation or other related issues. So those are two things we're absolutely seeing that are driving claims right now.
And so when you mention regulatory claims, we're also thinking industry-specific regulatory
Absolutely.
issues.
That's right. So certain industries, such as healthcare, are going to see a lot more activity than others. And other industries, given the current administration, are going to see less regulatory activity. But I think the point to be made is that as a private company, again, they are definitely not immune from this.
And we also have a new SEC enforcement head, Meg Ryan, so I think companies are trying to figure out what that approach will be, what her actions will be, and how that will affect their exposure going forward.
Can you break down the coverage differences between the private company and public company form and what that means for the type of protection that the leaders actually get?
The major differences between a public and private company form are really within the entity coverage in the policy. So a public company form is limiting the entity coverage to violations of securities laws.
And that differs from the private company form with respect to the entity coverage being very broad. Under a private company form, the definition of wrongful acts is important there and covers many more things beyond the securities claim.
You may also find that if you're a private company, you're also called a unicorn, and you have a certain amount of revenue, that underwriters may be hesitant to provide that full scope of entity coverage under a private company policy. Oftentimes those companies can be put on public company forms to mitigate risk to underwriters.
Also, in the defense that's provided under these policies, there's an important distinction there. On a private company form, you're essentially ceding control of that defense under a duty to defend form where the carrier controls the defense.
Yeah, and differently on the public company side, those are reimbursement forms, and so it gives the insured a little more control and autonomy in the defense of those claims. They typically have in-house counsel who may have been through claims like that before, and so they appreciate having a little more wiggle room with the carriers.
Something finally I want to mention on the private company form is that it may be placed as a package policy. So we're talking about D&O, but you may pair that on a package policy with ancillary lines of coverage, such as employment practices liability, fiduciary liability, perhaps even crime.
Are there any benefits to those package policies?
There can be, depending on the flexibility that the underwriter has, they may be able to premium allocate in a different way that's more beneficial for one line of coverage versus another. And you may also generate some leverage with that particular carrier by putting all of those lines with them.
Let's shift our attention to the market dynamics. What is it like for an insurance buyer today in the D&O market? And are there any trends that they should be aware of when going into their next renewal cycle?
From a public perspective, I think the market is still very competitive. We seem to be nearing a floor. We're kind of bouncing off the bottom. I think most public company clients can probably expect to see somewhere between a 5% rate decrease to a flat renewal. There has been some capacity contraction. We're dealing with a classic supply and demand imbalance, which is continuing the aggressiveness within the marketplace.
And speaking to the private company marketplace, we've definitely leveled off to a place where most insureds are going to see either a -5 or a +5 on that premium. So we're pretty flat, if you will, on average. Now, there is also an interesting shift in the dynamic of the conversation with these carriers. Given that premium isn't really the driver of the conversation, we are moving more into coverage expansion where we can. The other side of that conversation, though, is that we are seeing claims, the severity of which continues to increase. And many times it is because of this broad coverage that we have out there already. So how long we'll be able to maintain and press on expanded coverage is yet to be seen.
Let's talk about building the program. When it comes to an insured's desire to build a best-in-class D&O program, what is that like in today's environment, and how can it be achieved?
We would recommend that an insured take a holistic and cross-siloed approach to integrating risk with legal, governance, finance, and bringing all of those stakeholders to the conversation. That they should also look at their entire insurance portfolio. There are other lines of coverage that you want to make sure are dovetailing properly into your D&O to the extent possible. One that comes to mind is cyber, for example. The other thing that companies should consider is taking a multi-year approach to this discussion. There are a lot of things that can change within a company, change in the dynamic, in things coming at them over the course of not just 1 year, but 3 years and 5 years. So to really understand their risk appetite, what they can control in the direction that they're going, and build that program out over a period of years.
With regards to building a D&O program, it's important that you're efficiently deploying your capital to the areas of greatest exposure. As we know, we're in a softer marketplace right now, and so being selective around how you're allocating that premium, either between ABC coverage and Side A, or as Ashley mentioned, other coverages in your portfolio that could use those premium dollars in that capital deployment. I think it's also important to focus on coverage. Right now, it feels like there's less and less of a lever to pull on pricing and retentions as we're reaching a market bottom. And so making sure that you're paying attention to areas of coverage where you can broaden that scope for years to come.
And I would like to add to that when we are looking forward to the future of prioritizing these things, coverage, the allocation of premium dollars, I think it's very important, again, to bring it back to those stakeholders that are taking this holistic approach and to be in close communication with your broker so that everyone is aligned on what that program should look like and what the expectations are of the insured and what you can or cannot accomplish in the marketplace at a given time.
Closing out our conversation today, what are the top things that directors and officers should be thinking about when protecting not only themselves, but the companies for which they serve?
I think it's really important that directors and officers understand the evolving claims drivers in their industry and in their sector. How are tariffs impacting the claims environment? What does the geopolitical risk look like? And being very cautious around the disclosures they're making, particularly with regards to AI and cyber.
I also think it's important for directors and officers to educate themselves on the coverage that they have. So to work closely with your broker to understand the exclusions that may be in that policy, to overlay that with the claims environment education so that you know where the coverage should come into play and where maybe it will not. I also think that building a rapport with your underwriter is hugely important, and your broker can help facilitate that. You want the underwriter to really understand the risk the way you understand the risk, and so that they can underwrite to that specifically and build out a program with you in partnership that actually meets your needs.
Thank you, Ashley and Joe, for joining me for an excellent conversation. And thanks to all of you for joining us. For more insights from Locked In, subscribe to our YouTube channel, follow us on LinkedIn, and visit our website, lockedin.com.